Greg, it's great to have you here. Is this all sustainable?
Well, I think the big question is, how long can the consumer continue to weather this before we start to see the spending buckle? Of course, the retail sales numbers that came out this week were really, really strong. Delinquencies are ticking up, but they're still at relatively low levels. And I think a lot of that's just going to tie into employment. So, until we get significant softness in the labor market, I don't think you're going to see a spike in delinquencies. But what is at risk is discretionary spending. So much of household budgets being poured into necessities, and inflation, hasn't yet let up, as Steve noted a moment ago.
And obviously, Steve, if your mortgage is a fixed rate, but your credit card isn't. So all of a sudden, we're talking about that rate jumping up every time the Fed hikes. And yeah, we don't talk about it that much, but these balances just took out their pre-pandemic highs.
For sure. And the idea is that it's a measure potentially of stress in the economy and by the consumer. There is another sort of explanation for some consumers. You got a job. You may be feeling a little better about the prospects in the future. You might take on a little more debt in that context.
Sure.
Plus, I don't think people appreciate enough. I was just hanging in Washington yesterday talking to Diana Olick. Mortgage rates are higher, and home prices still remain elevated. Seems like don't buy it. But if the choice is the couch in mom and dad's house,
right?
Then you're going to strive for it. So that's one reason why these mortgage levels are higher, is that people have to have homes, and they have home formation. And what Diana was saying from the woman's point of view was, and I guess also should be the man's point of view, it's not the marriage, it's the kids. The kids that create the housing demand.
Yeah, that's probably true. One more quick question, Steve. As we talk about the health of the consumer, we always look at the balance sheet. They're said to be in way better shape now, for instance, than we were 15, 20 years ago. Is that still the case, or are we seeing signs in the last couple months, especially of that deteriorating?
Okay, so there's two differences here, and perhaps Greg can comment on this. You have the lake of debt. That is actually a little bit lower than it was before the pandemic, okay? Then you have, delinquencies. That's a little lower than it was before the pandemic. Then you have the flow into delinquencies, those transitioning into 90-day plus delinquencies. That particular flow is a little bit stronger than it was before the pandemic. So we are seeing stress, and especially, by the way, stress among young borrowers. So that's an area that you're going to want to watch out for. Delinquency rates remain sort of below the pandemic level. Transition levels are above.
Greg, what would you comment, and where do you see the biggest signs of stress, if you see them?
Well, I think the trend is really what's the concern. The delinquency is still below pre-pandemic levels, but they're not moving in the direction we like. When we talk about the stress, look at credit card balances, credit card rates, and how many people are carrying balances. They've all increased. So it's not just that the balances have gone up. They've gone up at a time when credit card rates are at a record high, and we're now seeing more and more households carrying those balances. That's, a bad combination right there.